Vanakkam. On behalf of the Taxation Committee of SARC of ICAI and on behalf of the Chairman CS K. Shanmugh Sundaram, I welcome one and all for this second day of the refresher course. May I now invite Mr. CS Satyanarayanan on to the dais. Thank you. May we now rise for the invocation.
य एष सुप्तेषु जागृति य एष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शितः सर्वे तदूनात्यपि कश्चन एतद्द्वैत 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 एतद्द्वैत.
Thank you. I will introduce you. We are on the second day of the 6-day refresher course on taxation. Today we have two topics: treatment of foreign exchange fluctuation under Income Tax Act 1961 to be dealt by C.S. Satyanarayanan from Coimbatore, and tax incidents on amalgamation demerger relating to companies to be dealt by C.H.G. Segar from Chennai. I would now introduce the speaker of the first session. Satyanarayanan is a partner of Aribhakti and Company Chartered Accountants. He is a Chartered Accountant, Information System Auditor, and has completed the post-qualification certification course of ICAI on IFRS. He has over 22 years of composite experience in servicing large, medium-sized clients in the areas of statutory audit, tax advisory, and management consultancy. Satyanarayanan has previously worked as a partner in Mr. Surya and Company Chartered Accountants for 16 years. Sector-wise experience. During the course of his career, he possesses wide experience in audit and tax advisory of listed companies and other entities in private and public sector, encompassing manufacturing, trading, and services in automotive ancillaries, textile, banks, and financial services, healthcare, jewelry, real estate, agro farming, and livestock processing, besides construction, hospitality, travel, etc. He handles tax appeals before appellate authorities up to the Income Tax Appellate Tribunal. Major projects are the statutory audit across multiple locations for a leading public and private sector companies. Satyanarayanan is a fellow member of the Institute of Chartered Accountants of India. He is also a graduate member of the Institute of Cost and Work Accountants of India. He is a co-opted member of the Committee on Corporate Governance of ICAI, New Delhi. And Satyanarayanan has presented papers in various seminars, study circle meetings organized by ICAI, ICWAI, ICSI, and other educational institutions. I now introduce C.S. Satyanarayanan for the August Guardian.
A very warm good evening, friends. My sincere thanks to Mr. Arulali for having given me an introduction to this audience. It is heartwarming to see a week-long taxation refreshing course being conducted by the SARC of ICAI, covering certain specific topics under the Income Tax Act. It's always very useful and purposeful when certain specific topics are taken for discussion rather than general discussion on various tax topics. So I should congratulate Mr. Shanmugasundaram, Mr. Aruloli and his team for having put this into action. And it is my pleasure to be a part of this refreshing course, and for which I am again thankful to Mr. Aruloli, Mr. Shanmugasundaram and his team. Thank you very much for giving me this opportunity, Mr. Aruloli. Friends, the topic given to me today is the treatment of foreign exchange transactions under the Income Tax Act. I would like to have the agenda for the discussion as follows. We'll have an introduction of this topic first, then we'll move to the effects of foreign exchange fluctuation, the nature of foreign exchange fluctuation, Rule 115 and 115A, the judicial precedents, the derivative based transactions. We shall deliberate on the salient distinction between hedging and speculation. Then of course the all important circular or the instruction of the CBDT which came out in March 2010 and which suddenly the department thought it was very important to follow it. Before I go into the discussion, you'll have to excuse me if my presentation of slides are slightly different from what has been circulated to you. I have made some small changes, so kindly bear with me for the changes. And I would like to basically get clarified, Mr. Aruloli, whether there are any people from the Income Tax Department here.
There is all are our audience. It's a closed circuit.
Okay. Not that I am going to be having any personal remark on the Income Tax Department people, not really. But my limited experience shows that some people are very, very, very sensitive to even certain fair remarks made on them. So I thought I would just like to get that clarified. Friends, foreign exchange fluctuation. Yes, the maxim goes that change is the only permanent phenomenon, and foreign exchange is no exception to that. It is basically the change in the value of transaction in a currency other than the local currency or the other than the reporting currency. To be very honest with you, I am exposed to this practice for almost 2 decades now. Till 2 years back, virtually this issue was a non-issue. What is becoming a big issue these days was certainly a non-issue till about 2 years back. Not that this was accepted and or the treatment that was given by the SSEs was straight away accepted by the department, but it was debated less than compared to various other matters such as the revenue capital expenditure on replacements and 43B and reopening of assessments, double taxation avoidance agreements impact. When compared to all these matters, the forex fluctuation was basically a non-issue till about 2 years back, thanks to some very nice judgments by the ITAT, the High Courts and the Supreme Court. We thought everything was put at rest. There is no issue on that. Suddenly it came up about 2 years back when the SSEs started claiming huge losses under the derivative transactions. That is where this whole concept again suddenly got erupted from the Income Tax Department. For decades, the SSEs have been claiming or offering the exchange fluctuation gain or loss. There was no issue, barring few. But when the volume of claim was enormous, then department thought that there was something wrong and some fictitious claims are being made. And immediately they rolled out a circular which according to me, personally, according to me, is absolutely incorrect. The person who has drafted that notification, it might be an internal notification. You see, I am sure many of you would have gone through that notification. Might be an internal notification, but we are all aware that any CBDT internal notification is binding on the department. So income tax authorities, they were virtually not bothered to hear your arguments, at least at the assessment level. They had shut their ears to our arguments, plainly depending on following the notification that was issued in March 2010, saying that no provision will be allowed. No provision on forex fluctuation will be allowed, or allowed to be claimed as a deduction, or allowed to be capitalized. In spite of the fact that there are Supreme Court decisions squarely covering the issue. In fact, I am sometimes, I always feel that the practicing chartered accountants also need to be slightly cantankerous sometimes. At least through the associations we must do it. If that notification, if this is not a contempt of court, what else is it? The Supreme Court has clearly given the guidelines as to how an expenditure with relating to forex should be allowed or allowed to be capitalized. In spite of that, this CBDT internal notification rolled out. The only saving grace that the department could take probably would be the title of that notification. It says clarification regarding 43(5) of the Income Tax Act with regard to exchange fluctuation on forex derivatives. It's only the title. But what they have gone ahead in the notification, we'll come to it little later. Now, having said this, the department were happy to assess the gains on forex when it was offered, but suddenly they were not happy to allow your claim as deduction. Having said this, let's turn to the assessee's side. Leave alone the fact whether there was a loss or not. That is debatable according to the department. That we leave it aside. But what went into this? It is basically the greed, nothing else. I am a practicing chartered accountant. I am defending my clients before the various appellate forum, saying that these derivative losses are business losses and have to be allowed. That apart. But my personal view about the whole thing is, it is just the greed. What was available to the businessman as a genuine hedging instrument or hedging tool was actually misused, or rather abused. If you see, when these derivative issues came, because please note, I am not going into the details of derivatives because it's a topic by itself. It requires almost a day to cover the different types of derivatives. But a forex fluctuation, a discussion on forex fluctuation cannot happen without touching on the derivatives. The moment the company had huge losses, they had the board disowned their CFOs, the board disowned their financial controllers, their company secretaries. They said that the transaction was ultra vires the company, the CFOs have acted more than their powers that were given to them. They started blaming the bank, saying that they have cheated us. We were innocent. We didn't know the effect of it. My simple question to the assessees are you fair? When you had gains, you were jolly well accounting the gains, enjoying it. When it came to losses, you immediately said that there is everything wrong on the other side. Same as what the department is doing. The assessors also started doing. The department said, when it is a gain, I will assess you. When it is a loss, I will not allow. Same thing. When there was a gain, you accepted it. But when there was a loss, you started pinpointing fingers on the institution and your own employees. Just imagine, friends, how many CFOs were dismissed from service on account of these derivatives. People who were closely monitoring the issues on derivatives during that time would know. Even top companies had their top finance executives exiting because of these derivatives. I recall what Mahatma Gandhi said. There is everything in this country for the need of a person, but everything that is available is insufficient for a greed of a person. That is exactly what had happened in this derivative transactions. So we'll discuss it later. So the impact of such forex fluctuation could be on revenue, could be on capital. See, the issue is simple. Let us for the time being forget whether it is derivative or whether it's a plain loan or an import receivable, whatever it is. Finally, the basic principle of income tax remains the same. Is it all for revenue or for capital? If it is revenue, you take it to P&L. If it is capital, take it to asset. It remains the same. There is no change in that. Even the decisions of the Supreme Court also fell in line of the standard principles. Yes, of course, subject to certain exceptions here and there, and depending on the specific section that was brought into the Income Tax Act for this derivative or this exchange fluctuation transactions. We can look at the effects of this foreign exchange. Basically, it can be classified into three. I'll go from the bottom. It's the real effect, the notional effect, and the notional effect subsequently converting to the real effect. What do you mean by real effect? What I meant by real effect was where the transaction arises and gets settled in the same period. Then it's a real effect. It could be instantaneous also, where I just make a forex payment and account the transaction. It could be a purchase of goods or service. It could be a sale of goods or service. Whether it's a credit or a debit or an expenditure or an income, where I just make an instant payment and account it, or if I account it today and account the settlement within a short span of time, within the same accounting period, then the effect is witnessed and the impact is seen in the same period. Then the effect is real. We know what the effect is.
1 minute. The car number AP7663 is into the right way of another car to go out.
No problem. Then coming to the notional effect, it is the other way, where the obligation is where the obligation arises during a particular period and it gets settled in a different period, which compels you to restate or redefine the value as on the reporting date. So there is a notional element there. Income Tax Department is allergic to the word notional, or rather I should say they got confused between the mercantile system of accounting and the notional. Whatever is provided for, they think it is notional. Not really. There is then in that case there must be only one system of accounting called cash basis of accounting. It's a mercantile system of accounting. You need to account your expenditure before it is actually incurred or disbursed, and you need to account your income before it is actually received. So you can't blow hot and cold. The last one is the convertible notional effect, which is the combination of these two, where initially it might be a notional effect and it gets converted into a real effect once the settlement takes place. When I come to notional, is it a rule that all notional effect will certainly get converted into a real effect? Mostly yes, but there could be situations where your notional effect will continue to be notional. For example, when you're translating the foreign integral operations, there will be a certain amount of exchange fluctuation which would be parked in the foreign exchange translation reserve account, and that never gets disposed or disbursed or settled. It keeps vitiating. It goes up and down every year when you translate the foreign integral operations. So to that extent, or probably to that limited extent, there could be situations where the notional effect remains to be notional and does not get converted into real. Otherwise, the normal day-to-day business transaction certainly gets converted into real effect. Friends, foreign exchange fluctuations could happen under various circumstances. You could buy or you could contract to buy a goods or service. You could sell. You could take a foreign currency loan and repay the same in foreign currency loan. You could take a protection by hedging your foreign currency liability, whether it's revenue or capital, by entering into a financial contract or a financial instrument through a hedging tool, and there could be exchange fluctuations because of that. For covering the hedging, for entering into these hedging transactions, you may have to incur a cost which would also be involving foreign exchange fluctuation. There could be certain rollover premium when you are not interested to honor your commitment on a particular date or the assigned date and wish to roll it over for another term, then you may have to enter into a rollover charge. Again, it could be involving foreign currency fluctuation. There are so many situations where you could have this forex fluctuation. We could probably categorize these effects of these fluctuations under the different categories to a simple effect, the contractual effect, and the derivative based effect. A simple effect is nothing but where one end of the contract is in foreign currency, the other is in your reporting currency. Namely, you are buying a commodity, you are buying a service, you are selling your commodity, where only one end of the contract is foreign currency, the other is automatically in your local currency or the reporting currency, which is your INR. The contractual effect where both the ends are contractually in foreign currency, where the obligation as well as the settlement takes place in foreign currency, namely your forex borrowings. You buy in foreign, you borrow in foreign currency and you also repay in foreign currency. Derivative based effect. Now, before going into this effect, now for benefit of some of you here, I would just give a small example as to what a derivative is. Please don't mistake me if I make this statement. I am trying to be true to myself. If you ask me whether I am familiar with what a derivative transaction is, how a derivative transaction moves, an honest answer is no. I don't know. I am very sure many of our friends in the profession, I am sailing in the same boat as they are. Maybe we may not be interested to agree, or rather confess. It is such a complex one where probably other than the banker or the lending institution which sold these products, or to put it in a very nice way or rather diplomatically, where they nicely made up these products for sale, and some CFOs, many of us didn't understand what this derivative is. As I told earlier, this derivative is a topic by itself, so I would like to just confine my discussion to the exchange fluctuation and the treatment of it alone. But I thought I'll just give a small example as to what a derivative means. If you go by the definition of derivative, as what your AS 30, 31, 32 talks about, which is not yet mandatory today. It is nothing but a financial instrument or a contract, the value of which changes with the value of the underlying exposure. It could be an underlying asset, and where the investment for entering into the derivative is either the cost is very negligible or virtually there is no cost, and there is a certain settlement at a future date. Now this is the technical definition of derivative. If I may bring it into an example, many of us have a doubt whether forward contract is a derivative. Yes, it is. It is a derivative. A plain vanilla forward cover contract is a derivative. Let me take an example of, say, around 1 lakh US dollar is being borrowed at rupees 45 per dollar, which is called the drawing rate, the drawdown rate. That's the technical term used by the banker. So my liability today is 45 lakhs. I am supposed to repay this 1 lakh dollar 2 years down the line in one shot. So either I allow the market to move and just watch and settle it on that day without protecting myself with any sort of cover. It may go to 48, it may go to 49. On that day, I will buy this 1 lakh dollar at 49 and pay the banker. That is one option left. The other option is I protect myself by taking a forward cover. What is a forward cover? Depending on the movement, the present movement of the foreign currency and the past movement of the foreign currency and the expectation how it would move in future, I may enter into an agreement with the banker to say that, okay, if it is up to 47 rupees, I will take this cover. So on that day, on completion of 2 years from now, I will pay you 47 per dollar, by which you please give me 1 lakh dollar, I will return it to the lender. This is the second way. The banks, when they approach the customers, there was a circular, internal circular. I have friends in multinational banks. It was, all these came out from multinational banks only. The only other leading nationalized bank that ventured into this derivatives in a big way to earn the income was State Bank of India. And they burnt their fingers badly, to say the least. There was an internal circular amongst the foreign banks saying that please don't stop by lending in foreign currency, bring this as a package, sell this derivative also. What is this derivative? The banks started telling the customer, look, you have taken a 1 lakh loan at 45 rupees today. Your liability would also like to be in the same drawal rate. You can have the same drawdown rate of 45 when you settle it 2 years down the line. Then immediately the businessman was happy. Fine, what else that you need? But they said, you please pay a small cost, which is called the hedging cost. Yes, I would pay. But please adhere to the small conditions. The conditions were small, but the impact was big. They gave a range. Fine. If the dollar stays up to 52, or rather 50, no problem. You will get the drawal, you will get your 1 lakh dollar 2 years down the line at the same drawdown rate. Whereas today, if you book it by forward cover, you will get it at 47. But I am giving you another fluctuation up to 50 rupees. Even up to 50 rupees, you will still pay only 45 rupees. So it sounded very nice, all sugar coated. They also said, if it breaks the barrier of 50 rupees, then your protection is lost, which means you will have to buy the $1 lakh at the market rate and settle our dues. If you just calculate and see, it is nothing but leaving your foreign exchange exposure uncovered. Suppose you had not taken a forex. See, there is no rule that you must cover your forex liability. Not necessary. I can just allow it. See, I am part of various listed companies in Coimbatore, where a listed company is compulsorily under clause 49 of the listing agreement to have a forex policy in place. The board has to approve the forex policy, and there are listed companies where their policy is not to cover. Their policy is not to cover. They say it is a gambling. Nobody can predict the real movement. Even the so-called experienced bankers and so-called experienced CFOs failed miserably. So there is no need for us to cover. So we will take it as and when it comes. We'll cross the bridge when we come to it. So there are forex policies which say that our policy is not to cover. So just imagine what happens in this protection, your situation where you lose the protection and a situation where you don't even cover. It's the same. If you don't cover, you're going to buy it at the market rate and settle. Okay. But the bankers came with a rider. It is not enough you buy it at the market rate and settle. You might also have to pay us damages. Similarly, on the downside, they will go up to 35 rupees dollar, because it could go up, it could go down. So up to 35 rupees it can go down, but if it goes below 35 also, your protection is lost. What has that got to do with my liability? Because I am, as a businessman, my purpose is to cover the adverse fluctuation. I am sure a businessman wouldn't like to cover him for the gain. He would like to cover him only for the adverse fluctuation. But what has that got to do with your? But still, the bankers said that, the range, we will have it a range from 35 to 50. But they had all statistics to prove. See, again, let's also give some credit to what they said. All statistics proved that the dollar will not cross, in my example, 50. There was enough statistics to prove that it will not cross 50. But you please see what is today's rate. It's gone beyond 52, 53. They say it's likely to even touch 60 as things stand today. It's terrible now. So your protection is lost. Now this is where the catch was, and the businessmen fell prey to that. So it may be the intentions were honorable, but unfortunately what it delivered was not a happy situation. Now this is an example of a simple derivative transaction. When people in practice, and when the CFOs, when the businessmen, when the banks were not able to understand. Yeah. Pardon? Insurance against the risk, you mean? Risk of forex. Yes, they had an insurance cover, but I'll tell you, with due respects to insurance, leave alone forex cover insurance, our own insurance you please take, whether it is life or property or whatever it is. You tell me a case where your entire insurance is given. You come to the products. Correct. Maybe, in fact, I'll tell you, there were companies who had covered. In fact, some banks, they probably foresaw this loss, and they also gave one more feature along with their product, was to cover that insurance also. So they had even collected some premium for covering that insurance. But it all, see, the loss was so big. Your part insurance reimbursement never really mattered. There were companies in Coimbatore, I know, whose case even went up to the Madras High Court. Their losses were at least 10 years profits. 10 years profits got wiped out in 1 year by this forex derivative loss. So where is the chance for you to recover? That is when most of the businessmen went in for arbitration or one-time settlement. Yes, that's why in the beginning I said, no, correct. That's why I said I'm not entering into a discussion on derivatives because it's a topic by itself. I just thought I'll just give a small example to understand the impact of derivatives. Okay. Now, going back to the issue per se, most of the companies that suffered derivative losses and who preferred to go legally against the bankers, they decided to go in for a one-time settlement. Why? Because as usual, and we are no exceptions to that, as I'm sure many of you would have gone in for home loans. I'm very sure you would have taken some home loans. You tell me how many of you read all the entire 100 pages before you signed your home loans? You wanted to finish off before the Rao Galam is over, and the entire signature was done in 15 minutes time, honestly. So the clauses were so strict and so clear that the maxim that ignorantia juris non executed, ignorance of law is of no excuse, clearly applied in this case. That is why the High Court, the Madras High Court, virtually held it against the businessman in one leading case, and that led to almost most of the businessmen going in for one-time settlement with the banks. The banks had adequate protection as far as the clauses were concerned. So, coming back to the discussion, now, real effect of foreign exchange differences on trade transactions. Now, I would like to take certain specific cases where we are having difficulty under the Income Tax Act. Now, as I said earlier, the real effect is one where the transaction arises and gets settled in the same reporting period. Now, if you go to AS11, now as chartered accountants and even the businessmen whose accounts are subject to audit under the Income Tax Act, it is mandatory that the accounting standards prescribed by the ICAI have to be necessarily followed. But Income Tax Act, if you are aware, barring two accounting standards, there was a very nice article in Business Line 2 days back as to how these tax accounting standards which are proposed may not really serve the purpose. It will only add to the confusion. But I am sure department is not going to listen. They are going to come out with, CBDT is going to come out with their own tax standards. So, department is initially who were in agreement with all the accounting standards of ICAI, they are not very happy these days. They are saying that you are trying to take cover by some notional claims and other things. Now, accounting standard 11 is presently, that's the only standard available to deal with Forex. The AS 30, 31, 32, all those things are optional. I don't think it has really come into play, and very few companies have early adopted those standards. So, AS 11 talks about the exchange rate difference between the date of transaction and the date on which the settlement. I am talking about only the real effect, first instance, where the settlement also takes place in the same period. It should be charged off to P&L or taken credit in the P&L as an expense or an income in the reporting period. That's what AS 11 says. Here we need to mention about Rule 115 and Rule 115A. In fact, I am sorry to state that, many a time we really don't bother to look into these rules. This Rule 115 and 115A is some of the rules in the Income Tax Act where we really don't bother to look into, because it has specified as to how you must account for the Forex transaction and at what rate. See, the key in a Forex transaction is the rate at which you account it. Now, Rule 115 is very clear, which gives the class of transaction. On one side, the salary is the interest on securities, house property, business, income from house property and business, and income from business of NRI, dividends, capital gains. It all tells you as to what is the rate that you must adopt for accounting these. These are mostly on the recipient side, on the income side. If you are accounting these income, at what rate you must account for? And from the expenditure side, on the withholding tax provisions, what is the rate at which you must account for, so that you calculate your withholding tax rate on what is on the arrived value, determined value. If you see the business income, it talks about the last day of the previous year. That's what we are doing. Here the department took a stand that whatever be the transaction, whether you settle or not, whenever there is a forex transaction, rule 115 is mandatory. So if you take for example salary, it says last day of the month preceding the month in which the such salary is due. But do we account like that? If you are providing for a salary in our books for a foreign operation, say for example $30,000 you are providing at the year end, are we taking the last day of the month preceding the month in which the salary is due? Do we? No. But fortunately, for withholding tax purpose, salary, the withholding tax liability arises in the year of payment. So we get escaped there. Okay. But otherwise, if you see, the rule 115, it should be applied only in case where the liability or the obligation is outstanding on the reporting date, not during the transaction date. This was what was the decision given by the Supreme Court, very old. It is in Chaugle case, what's the citation? I think it is 68 taxmen. As old as that, the Supreme Court has very clearly said Rule 115 is not to be applied across to all transactions. If it gets settled in that year, it should be as per the settlement rate. There is no question of applying previous month rate and last day rate and other things. For outstanding transactions, foreign exchange transaction, yes, Rule 115 is mandatory. So we had some cases here in 115 where the department started assessing, started disturbing, tampering the value at which the transaction was recorded based on this Rule 115. And even this capital gains, if you see, suppose we dispose of an asset outside country. It's not uncommon these days to have an asset in your books in foreign currency denominated, representing an asset outside India. Suppose you're selling an asset. Take this for example, how this will work. Now, normally if you say, I'm just for the time being ignoring the indexation and all those complications. Assuming the cost of acquisition is 4 lakh US dollar and the cost of improvement is 70,000 US dollars. And we also incur for about $1 lakh for selling this property. And the full value of consideration is 10 lakhs. The capital gain, you need to arrive it at $4,30,000. That should be translated at that rate as per 115. It is not each. For example, when you bought the property at 4 lakh, you would have recorded it at a particular rate. I'm sure you would have recorded, say you would have brought the property 2 years back. You would have recorded it at a particular date, a particular rate. Okay. But Rule 115 says, forget all those things. Don't say this is my value in INR for this property and this is my cost of improvement and this is my cost of making the sale and this is my consideration, balance is capital gains. No. They want you to denominate first in foreign currency, arrive at the capital gains, then you translate at the rate. There is a difference. It might sound as though it is same, but it is not so. There is a difference. Okay. Whereas, if the transaction happens on the part of an NRI, then Rule 115A is applicable, where the basis is slightly different. They have everything gone by the TT rate as on the date of transaction. For a cost of acquisition, they say that the TT buying rate and TT selling rate on the date of acquisition, the expenditure wholly incurred in connection with the transaction should be as per the date of transfer. Similarly, full value of consideration, it should be on the date of transfer, and accordingly you will have to recompute the capital gains. So there is a distinction between 115 and 115A. Why I brought this into today's discussion is just to tell you that there is no rule that 115 should be applied across all transactions, only for transactions that are outstanding on the reporting date. Now, what happens to the real effect of foreign exchange difference? When I say real effect, again I repeat, I mean the arising of the obligation and the settlement takes place in the same period. There is no restatement happening. Now on capital account, now, barring this section 43A under the Income Tax Act, there is no other provision under the Income Tax Act which talks about forex fluctuation. No other section virtually. It is only this 43A which talks about the forex fluctuation and how it should be treated under the Income Tax Act. Even there was an ambiguity, and after the Supreme Court took up this case in Woodward Governor, the Act was amended with effect from 1/4/2003, stating that it should be only on payment basis. Otherwise, only 43A simply states that if there is an increase or decrease in the liability, forex liability, consequent to the exchange rate difference, towards either the settlement or whole or part of the cost of the asset, or the borrowing specifically for acquiring those assets. Either way, either you have a deferred credit with your capital equipment supplier, or you take a loan and use that for acquiring the or acquiring or settling the foreign currency liability for acquisition of asset. Either way, if it is towards this, the increase or decrease in liability should go to adjust your cost. Now, it also says, it does not use the word assets purchased in foreign currency. 43A very clearly says acquisition of an asset from a country outside India. So you might have taken a foreign currency loan in India, and you might have used that foreign currency loan for purchase of an asset in India. Then 43A will not apply. 43A will apply only when you purchase an asset in foreign currency from a country outside India. So there is a clear difference there. 43A will apply only for imported machinery, not a local machinery. But the local machinery can be bought by foreign currency. Still 43A will not apply. So 43A is very clear. And probably this is the only section which allows you to tamper the definition of actual cost under section 43.1. 43.1 is very clear, which says the cost cannot be altered. It is once and for all. Once you incur, that's the cost. But subject to 43A. There was a dispute here for the payment. The earlier section before the amendment, pre-amended section of 43A said, for the foreign currency liability, for making the payment towards foreign currency liability, the department took a stand. Since the word payment is used, it will be allowed only on payment. To mean they will allow you to, they will not allow you to claim it as a deduction, which of course is as per 43A. You have to only capitalize. But they will not allow the depreciation unless it is settled. That was the original stand. But Supreme Court in Woodward's Governor's case very clearly said it was a decision rendered by the present Chief Justice of India, Sri Kapadia. In fact, I should share that I had the honor of being there in the Supreme Court when one of my clients' case was taken up, and it was the judgment was delivered by Mr. Kapadia, the present Chief Justice of India. I heard he is a chartered accountant also. The understanding was amazing. The understanding of his capability to understand and immediately assimilate the issue was amazing. So it was his judgment which said that the section is clear. There is a difference between for the purpose of making the payment and on payment. There is a difference. So unless it is on payment, you cannot say that I will allow depreciation only on payment. So it has to be allowed, depreciation has to be calculated. Now please, these are some of this is very important. See, this observation, the observation in Woodward's governor, later on followed by the ONGC, followed in the ONGC case, these are the basic questions that the Supreme Court raised. As long as the assessee is able to handle the 6 questions, I don't think the department has any chance to say that our expenditure is not allowable. Even now, post the CBDT notification, I don't think they stand a chance. Now the question asked is the system of accounting followed by the assessee mercantile? If it's a mercantile system of accounting, yes. Is it being consistently followed? Or there is no necessity that you must have always had the method of accounting in a particular fashion. Even if there was a change, was the change bona fide? Then was the treatment given by the assessee to loss and gain are the same? Just because it was a loss he claimed and for gain he did not offer. Was there a situation? And regarding passing of entries in the books of accounts, no, there are companies who take certain gains directly to reserve without routing through the profit and loss account. There are even cases I have seen with a reference by the auditor with a remark that losses were straight away adjusted against the reserves, stating that it is a past liability, the settlement happens only now, but the contractual obligation happened earlier, and the difference in settlement has to only affect the past reserves. So there could be difference in accounting treatment. So whether the accounting treatment has been consistent with what has been claimed in that year. Then is the method adopted for the assessing making book both for respect and losses and gains nationally accepted accounting standards? Yes, we do. We are compelled to follow AS 11 till date, whether it is in line with the nationally accepted accounting standards. And is the system adopted by the assessees fair and reasonable, or it adopted only with a view to reducing the incidence of taxation? Now, if these questions can be handled by us, I don't think the department has any case for not allowing your forex exchange loss as an allowable deduction subject to 43A. Trade transactions, nothing to talk. Whatever happens in the revenue field has to hit the P&L. The accounting standard also says that there are no exceptions to that. When it comes to notional, this is where, I do not know whether I may say so. The government has principally decided to fall in line with the internationally accepted accounting principles. The way the Ind AS started getting rolled out, except that the date is still uncertain. But if you see the amendments, including the revised Schedule 6 that is being suggested now, everything is falling in line with the internationally accepted accounting standards, namely the IFRS. It is in line with that. Though we might call it in any other name, but the fact remains that we have to align ourselves to that. We don't have a choice. But once it comes into play, no forex fluctuation is allowed to get capitalized. It has to hit the P&L. Whatever be it, whether it is capital asset, whatever be the obligation, if there is a forex fluctuation, it has to hit the P&L. Because the global standard is that a forex fluctuation cannot alter the cost. It has to be on revenue account only. So this is an issue with the income tax department, which I am sure will continue to be there. Now, even here, when the revised AS 11 came, it was very clear, saying that everything has to hit the P&L. Then there was a big hue and cry from the industry, saying that our financial results will totally get distorted in 1 year, because there was huge forex liability for acquisition of assets. Then came this circular on the last day of the accounting year. Department of Company Affairs gave a circular in 225E, circular number 225E, 31/3/2009, where they allowed you to exercise the option of capitalizing with retrospective effect from 7/12/2006 to 31/3/2011. Past years, you must be aware that it was taken to the reserves, and that current year, namely 2009, it hit the, it affected the cost of the asset. No, I do not know why this was done in such a case. Of course, you could have always seen it as an exceptional item and then taken it. I do not know why this was taken as a very exceptional item. To put it very crudely, I should say, the government also allowed a legal fudging of accounts. They allowed you to fudge the accounts for these years. Again, it was done for a period up to 31/3/2011 because they were under the wrong impression that IFRS or the Ind AS will come into play from 1/4/2011. That is why initially it was 31/3/2011, and we know it is slowly becoming like our company's bill, which came, went, it never came as an act. Now they have extended it by one more year. Now up to 31/3/2012, you can continue if you had exercised the option of capitalizing the forex fluctuation on fixed assets. Then you can continue up to 31/3/2012. Thereafter, it has to hit the P&L. Okay. Now, the income tax department is now saying, if there is a contractual obligation, then they are saying this loss is contingent in nature. They say it's notional and it's also contingent in nature. Yes. Loan liability. Now, see, the revenue transaction also they were holding it as notional and contingent, but that is being allowed now. Even this notification, I'll come to that notification which they gave a little later, where they are very clear. I'm only talking about the loan liability on acquisition of assets. Yes. Do we have an accounting treatment prescribed for derivatives presently under the accounting standards, present accounting standards? The answer is a big no. We don't have any accounting standard today to guide us as to how a derivative transaction loss or gain to be accounted for. To a very limited extent, to a plain forward vanilla cover, it is available in AS 11. AS 11 per se does not talk about derivatives. The income tax department also confuses it, saying that the institute has given it under, the government has agreed under AS 11, but not really. Derivatives have nothing to do with AS 11. But the forward cover premium, the rollover charges, are these forex fluctuation? Now, this is again another issue under the Income Tax Act. Is it a finance cost or a forex fluctuation? When I take a derivative, when I pay a derivative premium, is it a forex fluctuation, or the fluctuation consequent to that, is it a forex fluctuation or a finance cost? Anything that is denominated in foreign currency, anything that is associated with a foreign currency transaction, the Income Tax Department says it is only forex fluctuation and their present notification will apply. They are not agreeing to the fact, they are not able to draw the distinction between a finance cost portion of the forex premium. Similarly, the rollover charges. Are we clear about the fact that we don't bring the derivatives at all into the books? I hope we are clear on that. A derivative transaction doesn't get accounted in the books. Only the loan liability, the initial loan liability, gets accounted in the books. The protection or the cover or the hedging tool, namely the derivative transactions taken to cover the exchange risk, never gets accounted in the books. It is an off balance sheet item. That's why if you see the notes to the accounts, most of the time we don't give much of attention to the notes to the accounts, neither we nor the regulatory authorities. They don't give much of importance to the notes to the accounts. If you see the notes to the accounts where you are under compulsion to disclose your forex exposure, that is why if AS 30, 31, 32 comes into play, AS 30 is about the recognition and measurement of forex. of financial instruments. Then one is the 31 is the presentation, the other one is the disclosure. If you see, come to AS 32, which is about the disclosure, there's an enormous disclosure on this, where once this AS 30, 31, 32 comes into play, you have to account the derivatives also into the books. You are compelled to account that. Presently, derivatives are off balance sheet items. Only when you go through the notes on accounts, you will know what is the commitment towards that. But only when it gets crystallized, it hits your P&L. So it is really an unknown devil sitting outside. Okay.